Hello again, this is Blaine Carr and I am a Senior Wealth Advisor with Petersen, Hastings. We are an independent wealth management firm with offices in Kennewick and Walla Walla, Washington. We are passionate about fiduciary-centered advice and education to our clients, prospective clients, and community. Today I will cover Joe Biden's tax proposal and how this might impact your tax situation in the near future. According to his website, Joe Biden will not raise taxes on anyone making less than $400,000, period. So there really is a quick answer here. Expect your taxes to go up if your income exceeds $400,000, and there'll be potential tax savings for those of you with income less than $400,000. But most things in life aren't that straightforward, especially anything to do with the U.S. tax code. But before we dive into this further, I need to address the current political landscape. While a Biden presidency is almost certain, the Democrats have control of the House of Representatives, and the Senate is still up for grabs with a runoff election for both seats in Georgia slated for January. If the Democrats win both of those Senate seats, they will have complete control, and you can pretty much expect most of the provisions in Biden's tax proposal to become law. That scenario isn't likely, which means there will probably be some compromise, and it will probably take longer for a Joe Biden tax package to pass. At this juncture, I'd say there won't be any major changes to tax law that will apply to 2021. But I also recommend holding off on your major 2021 tax decisions until next fall, especially if your income is anywhere near $400,000. Many of our current tax provisions, including tax rates, took effect in 2018 through the Tax Cuts and Jobs Act. Those provisions will expire after 2025 if Congress doesn't vote to extend them. I will now cover some of the main aspects of Biden's tax proposal. In doing so, I will show how the proposed tax provisions compare to current tax law and what action you should consider taking. First, the individual tax brackets. We should continue to have 7 tiers, with most of the tiers remaining similar to what we have today. The big change occurs when taxable income exceeds $400,000. One major question is whether Biden's reference to $400,000 of income applies to those filing single or married, and whether it is adjusted gross income or taxable income. Either way, it will lead to even higher tax rates for high-income taxpayers. It doesn't stop there. While most deductions are likely to remain in effect, these taxpayers will likely see a cap on the rate their itemized deductions receive. This means income could be taxed at nearly 40%, while deductions will produce only a 28% tax benefit. In addition, more Social Security tax will be assessed on wages and self-employment income exceeding $400,000. Top capital gains rates will also double from 20% to nearly 40%. One of the more unusual ideas Biden has is a change from employee 401k contributions generating a tax deduction to a credit. Currently, these contributions reduce taxable income at a taxpayer's current tax rate. The proposal is to convert this to a 26% tax credit for everyone. What this means is those in the lower tax brackets will receive a higher tax benefit, and those in the higher tax brackets will receive a lower tax benefit. This idea really leaves me scratching my head. For now, I would hold off on making changes, but if this becomes law, I recommend switching to Roth contributions for those of you in the 32% bracket and higher. If your 401k plan allows you to contribute to Roth, and if you expect high income in retirement. All in all, taxpayers are likely to pay more than a 40% rate on income exceeding $400,000. The marginal tax rate on an extra dollar of income could exceed well over 50% when factoring in the reduction of many credits and deductions. For those of you in this situation, consider accelerating income into 2020 and possibly 2021, as well as accelerating some personal deductions into 2020 and 2021. Okay, the good news. Biden's plan does include some benefits for individuals. The child tax credit and the child independent care credit will be expanded to $3,000 and $8,000 respectively. But the phase-out ranges for these benefits are likely to be lowered. For those of you who itemize deductions, the current $10,000 cap on state and local tax deductions might be removed, which would result in increased deductions and lower taxes. In addition, tax relief would be offered for student debt forgiveness, and the first-time homebuyers credit might be restored. I would also remind you of the proposed change to 401k contributions. Because this may take the form of a refundable tax credit, those in the 24% and lower tax brackets should switch your 401k contributions from Roth to pre-tax in order to take full advantage of this credit if it becomes law. Now to business taxes. The corporate rate decreased from 35% to 21% back in 2018. The goal was to make our high U.S. corporate tax rates more globally competitive. 21% is a fairly low tax rate, and an increase to 28% is one of the least controversial items in Biden's tax proposal. In addition, Biden is looking to bring back the corporate minimum tax to ensure corporations pay at least 15% for a tax rate on book income, which affects those corporations with a lot of tax preference items. If you have a C corporation, you should strongly consider accelerating some income into 2020 or deferring some expenses to the future in order to take advantage of the current 21% corporate tax rate. The 199A tax provision made its debut in 2018 when C corporations rates were greatly reduced. 199A is a mechanism which equalizes the taxes paid by large corporations and small business owners. This is done by allowing a deduction of 20% of a business's qualified business income. The income from most small businesses is referred to as pass-through income because it is passed through and taxed on the personal returns of the business owners. These businesses are formed as sole proprietorships, partnerships, S corporations, even some estates and trusts. At this point, it looks like Biden is in favor of retaining the 199A deduction on income below $400,000. My general recommendation here is to accelerate business income into 2020 and push deductions out to the future in order to receive more 199A deduction in total. Do be careful if your business is considered non-qualified because you might benefit more from pushing income out past 2020 or accelerating deductions into this year. Let's transition to estates. Very few estates pay federal estate tax, but more will likely do so in the near future. Biden would like to return to the 2009 rules, which would lower the federal exemption from $11.6 million to $3.5 million. And it would raise the top estate tax rate from 40% to 45%. As a quick side note, don't forget about estate taxes at the state level. Washington State is tied with Hawaii for the highest estate tax rate at 20%. Washington's estate tax exemption is about $2.2 million. In addition, Biden is in favor of removing the step-up in basis rule. Currently, the beneficiaries of after-tax assets receive higher cost basis on those assets, which results in lower capital gains taxes in the future. Eliminating step-up in basis would increase future taxes on beneficiaries of all sizes of estates. So I recommend continuing to make present gifts to beneficiaries and charities, as well as naming disclaimer trusts in your will in order to reduce the size of your taxable estate. Individuals can give up to $15,000 each year to other individuals without being subject to gift taxes. Those with higher net worth should consider gifting more than $15,000 annually in order to remove appreciating assets from their future estates. And charities can also benefit from gifts from you, and you would receive a current tax deduction for those, subject to charitable giving rules. Okay, let's wrap this up. There is a possibility that tax rules will not change in 2021. The target for tax increases appears to be on individual taxpayers with incomes exceeding $400,000, C corporations, and estates. Some individuals stand to receive larger tax deductions or credits from the Biden tax plan. This tax proposal will probably take some time to pass and likely will not pass in its entirety. Whether you stand to win or lose, it is important for you to have a strategy. Your action plan might involve accelerating income and postponing deductions, or vice versa. A Roth conversion might be beneficial, as would be reviewing your estate plan and considering annual gifts to individuals or charities. Also, for those of you who are contributing to your 401k accounts, you should revisit whether it benefits you more to make those contributions on a Roth or a pre-tax basis. As always, do check with your experienced tax advisor, wealth manager, or attorney prior to taking action. I hope you enjoyed this video so much that you share it with your family and friends. Also, I encourage you to visit our website at www.petersenhastings.com. Bye for now.